This one city in Florida is now the worst housing market in America, and it's showing flashes of 2008. Values here are already down over 15% from peak. In the last crash, they dropped by as much as 57%. I'm, of course, talking about Cape Coral, Fort Myers in Southwest Florida. The Wall Street Journal did an article back in mid-2025 calling Cape Coral the worst housing market in America. Now, Bloomberg is talking about how foreclosures are surging as easy money loans backfire on rookies in the home flipping market, which is leading to a massive surge in abandoned, unfinished projects being sold on the market. This is exactly what happened last time. Cape Coral peaked, rolled over early, and then kept falling while the rest of the country was still in denial. It's not just another Florida market, it's the canary in the coal mine, and ReVenture actually called this downturn in early 2024 before anyone else.
All right, so it turns into an advertisement. But who's not been listening to these videos? They're rolling through, they're pushed. And I don't want to deny anything that's happening here, but I want to spend a little time here talking about how we can best understand what's actually going on in the marketplace and how to uncover for ourselves what we're seeing, what is out there, what is specific to our market. I talked the other day about an agent I spoke with that said, hey, I just got off the phone with another agent in your market. And they kind of indicated the kind of days on market is in the 70 to 80 day range. I said, interesting. She's like, well, why are you saying it's only in the 30 to 35 day range? I said, well, depends what information you're looking at, right? We can curtail statistics. I'm going to show you kind of how we can dive into that because it's critical for us to be niche down into the markets in which we work and understand the way in which this actually happens, the speed at which things are selling in particular markets, and not even just in those markets, but the difference of condos in a market versus single family homes in a market, right? Where is the demand coming from? What are the issue points? Because what happens in these videos is everything gets lumped into a single talking point. So I want to go back and reference what's happened to us in the past. I want to go back to 2008. And just really understand what's going on there. So I keep hearing it. This feels like 2008. Well, does it? Let's actually talk about what 2008 looked like. Because most agents that talk about 2008 weren't licensed and they weren't working in the market. My story, I remember specifically, I was in college. I was at in a commercial banking class when we started getting news that Freddie and Fannie were going under. So I remember like my professor just turning on the TV. It was like 9/11 meets financial crisis because never, in their lifetime had never happened before, never would again. So in 2008, lending standards were extremely loose. This was all, you can, people debate the origin of this, but go back to, policy making that wanted to make sure every American had the ability to reach the American dream. American Homes Act, I believe it was from the late 90s. But how long do these policies take to actually take effect? I think it's one of my biggest frustrations with politics is nothing happens fast, yet we judge them based on the immediate results, not the long-term results, right? We never get policy that lasts that long because we then started doubling down and making changes and tweaking and regulating against that policy. So lending standards were extremely loose. Freddie and Fannie were, loosely buying mortgage-backed assets. They were 0% down loans all over the place. Now, if you go back to 2005, 2006, if you were getting no money down and the market was moving in your favor, you quickly could then go refinance it. You had 20% equity. You could, pull out you'd be in more of a conventional 20% down, pull out cash. I mean, you could do all kinds of things. So stated income loans were quite prevalent, meaning, hey, what do you make? Write it down. The lenders from those days say if you could fog a mirror, you could get a loan. No one has experienced that recently. Spec builders were overbuilding. The money was there to do it, and the buyers were very, very available. Investors with 10 plus investors had, many properties. You'd have, if anybody's watched The Big Short, the classic is the stripper with 5 properties, right? Everybody's doing it. Credits froze. Everything froze. There was a day that it all came crumbling down. Now, that's what I want to dive into. Is it all came crumbling down in the headlines? Banks stopped lending. They were bailing out banks because of their balance sheets. So it wasn't just falling prices; it was frozen credit. People stuck owning homes that were in a depreciating market, and we began to see unemployment spike as a product of that as well. Is that what we're seeing today? Maybe maybe we are moving in that direction. I don't know. And I'm not here to make predictions on this. I'm just saying, look around. Is that what we're seeing today? So, lessons. Markets fall for different reasons. What was the reason behind that fall? The credit crisis, right? We had easy availability of credit to everyone, including the banks, right? It was policy that allowed for that to essentially allow the market to get just way overshoot its skis. The Great Depression, go back even further. We had a legit banking collapse. You had unemployment in the 25+% range. But today, it's an affordability issue. I think that's what we're, at the core of everything we're talking about, it's affordability issue. We've got costs of everything have been up post-COVID, right? Cost of construction, cost of labor, cost of, I'm amazed every time I get a quote on anything right now. I mean, it just feels like we're in this where everything's having to readjust, and yet we have not seen incomes adjust to account for it. Some incomes, but not most incomes. Most salaries don't reset fast enough to keep up with an inflated market. So we don't want to misdiagnose the market. If we as agents misdiagnose the market, we give bad advice. Our job is not to echo headlines. It's to interpret reality into what we're actually speaking about, right? The markets we're actually working in. So I'm going to share, I want to show you where we can actually dive in. And if we go to the Case-Shiller, so this is a great reference point. This just helps us kind of exemplify what we actually saw. So this is the National Home Price Index. And we can go look at this today. And you can read these like you read stock charts and make decisions on what you think. I think the challenge is each one of these, if you're used to reading stock tickers, each one of these tickers is a month, right? Patience. It's not done in 30-second blips like we see in stock market, or 1-second blips. It's not updated so quickly, because in real estate, what we don't get is immediate data points. And even when we have a data point, we don't get the full picture. We don't, because it's not a commodity. It's not a commodity in the sense that unless you're specifically talking about new construction and you've got that dialed in. The National Home Price Index does not account for the fact that if this was a dotted map, we're going to have dots all up and down this thing, right? Because you've got a house that is on the best lot, the best neighborhood with the best finishes. And that doesn't mean there's not exceptions to the rule. But I'm saying the information in which we have only is good over the long haul, right? It's not good in short-term decision-making. So here we are. We're in 2004, 2005, 2006 in the climb up. And we are getting to really what appears to be the peak. Let's see where this peak is. Peak is really in November of 2006. October of 2006. So right after summer of 2006, we were really in our peak period. Now, did we know it yet? No. Everybody felt it. Just like today, there was headlines about, affordability, about, this can't keep going. But then you would have experts, economists, that are making their housing pricing predictions based on this run-up appreciation rate, right? That was one of the things to me that was like, so your expectation is that housing is going to increase at this rate forever, right? I mean, where would be our data point today? Doesn't make sense. not without completely inflating the dollar. So that's what we're seeing now. Where do we have our real fall off? We've got, go to 2007. This is kind of the period where we felt the banking collapse. I don't remember the exact date, but it was in here. But where's our peak to our trough? So we said October, September 2006 as a peak. When do we start to move back up again? January, February of 2012 on the national index. Now you can go do this for your specific market. I'm certain you're going to see areas like Miami, and you're going to see areas like Vegas, and a lot of the areas that, we were told were the worst of the worst. They were, I mean, all the money was flooding there. And so what happened there is you actually had your data points that were just exceeding, dramatically exceeding. And I think we're seeing a little bit of that now when we look back over the course of 22, 23, right? What are these peaks? Where do rates change as a function of this, right? Because my ability to continue to afford this purchase price with a new rate impacts my ability to purchase it at that price, right? So we saw some short-term impacts of rates starting to increase as well. The question is, what does the rest of this map look like? And that's the thing we do not know. The thing we can predict. We can make our best guesses. I do think historically, this may be one of the greatest runs we will ever see. I don't know how you just look back on this map, man. March 2020. This is when, I remember it here when we were trying to figure out which way was up. And we said, man, it just doesn't seem like it's slowing down. Phones started ringing like crazy because people wanted out of certain markets. Now, I'll put a little asterisk on this period for a lot of the market. Now, I can't explain every market. I can explain what we saw in Florida market a little bit more. Was think about making effectively a currency exchange. You're exchanging the currency of a home in New York for a mansion in Florida, or an apartment in New York for a mansion in Florida. You're exchanging, a home in San Francisco, currency very different from a home in Florida, right? And so where we saw price increase, someone else saw value. And so I think it was a really excellent period of the first time when people could work remotely and were being actually forced to, where they had choice of where they resided, regardless of where they worked. And so not only did they make a currency swap in terms of San Francisco apartments for Orlando real estate, but they're also still making San Francisco money. Completely different worlds, right? And so what we saw is the affordability differing from the market in which they live. The market could go up dramatically. The affordability for those buyers did not really change. It actually improved because it wasn't just about the price of the house. It was about everything else. I had a guy in our neighborhood moved in from California. It was at a Christmas party this year. And he goes, man, people are still coming here. He goes, we were a little late to the party, but we still came. He goes, and the thing that amazes me every day is how cheap it is to live here. And we're like, tell me more. He's like, it's the simple things. And it was interesting just hearing him kind of reflect. He's like, it's the little things, like going out, getting gas, going to a coffee shop. You'd be amazed the difference. And he's like, I don't think people still, unless they've, come and tried it, still fully realize that quality of life's better. The cost of all the little things is greater. So the fact that he's still making California money living in Orlando, it certainly is a dynamic shift. So I want to dive into Cape Coral market here for a minute, just as that video started us off on. So this is Cape Coral. The Cape Coral home value is $333,000. $561, down 9.8% over the past year, and goes to pending in around 58 days. 58 days isn't bad. But the 10% is what gets people going a little crazy. One thing I want to do, so this is on Zillow. These are great. So I would just go to these. This is kind of real-time data, most of the data points in your current market, right? So you can go look at it for get more specific than this, but this is Cape Coral. We don't work in the Cape Coral market, so I don't have a lot of insight on it, but I'm curious when I start looking at this, all of the kind of moving factors here that create this. So we got all homes. I am interested to see. So all homes were average of 421 at peak, 333 at trough, right? Peak to the bottom. If we go to single family homes, what changes? We go 433, 343. So a $90,000 average reduction. Now, the thing I also have to remind everyone is what we're feeling in the affordability crisis, it is the affordable homes that are impacted, right? Somebody that's in a $1 million home that's in Cape Coral, that it's a second home for, and they actually work somewhere else, or maybe it's their primary home, whatever it is, but they've owned it for a long time. The affordability for that person is not as great. Affordability issue, right? Sure, other things are gone up, taxes have gone up, whatever, but it's not as great. And so the crunch we're seeing is in the lower tier price points, probably in these tiers. So although we have sales that are happening in the 7-figure range, the second home sales, the optional purchase and sales, by the higher income class, most of the market impacts are happening in this class, right? So it's important to know that this is a section of our market, and we would have to get very granular to understand that. And you can go look at the things that are selling, but this is the average of that marketplace. So if everyone above $1 million took their home off the market and said, we're just going to ride this storm out, let's wait, we're still going to get metrics that show us something like this. Okay. So you'd have to speak to someone in Cape Coral to understand that in a refined detail, right? There are homes that are sitting on these coastlines that aren't going to sell. I mean, some of them did when they got destroyed by a hurricane a couple years ago. Some of them got built back brand new with insurance money too, and they ain't going anywhere, right? So there's a challenge there, and so we can jump now to condos as well. Look at the condo market, 291 average at peak, to 199. So as a percentage, that's the greatest percentage of the market. What's that bring us to? Which just gave us some more details here. So we had 90. A 30% reduction. That's dramatic. That makes you so when you dial this into the condo market, let's do that too for single families. We said 90,000 as well, divided by 433. 20%. Still dramatic. Still very dramatic. But the condo market is leading the way in Cape Coral. And I think that's something that if you're in Cape Coral, you've got to be able to speak to. You got to be able to understand that. Now, where does this bottom out? Like, where is this proper number? Follow this. If this is a peak and this is a trend line, where is that real value? I don't know the answer to that. It doesn't always work that easily, but there is a place where it will start to bottom out. Supply matters. All the things they talked about in that video are still other outlier details that need to be considered. I want to jump here and show Kissimmee. Now I'm going to show you Kissimmee and Orlando and Oviedo. This is my markets, south side of town. Now, these are very, very different markets, right? But Florida gets lumped into that video we just looked at. This is Kissimmee. We've got a little bit of a downturn, nothing like Cape Coral, 379 peak, a little bit of a downturn here, down to 355, average trending sales, right? I can do this for condos as well. Condos definitely more impacted than the single family home market. Single family home market's pretty flat. Let me jump to Orlando. Actually, let me go back. Kissimmee, average of 5.4 reduction year over year. Okay. Orlando, 4% reduction year over year. Average trending sale price. Now, one of the things just to remember, and I think this is where we're actually seeing some of these impacts in real time. It's people that bought here that are now trying to sell. And it doesn't matter the market you're in, with the exception of this market. We got a market that matters for this. You could make money in 2 years here. In almost every other market ever, if you're holding it 3 years or less, it doesn't make sense to buy a house. Because the transactional costs are so great and markets just don't move that fast. Like, how many homes do you need selling in your neighborhood to actually create enough data points to drive your home price 10% over a 2-3 year period? You need a lot. So yes, we had that period. We cannot move forward with that mindset. So I challenge everybody listening to this, don't move forward with the mindset from the past. Reflect on the past as to what happened so you can predict going forward. But if you're just taking this same thing that happened in 2004 and the build up there, if you're just taking that and saying this will be continued forever, man, you have something else coming for you. Nothing continues forever. And then this Oviedo, little submarket, right? Submarket north side, completely up, 30, 40 minutes from Kissimmee. We've got a completely different experience. 482 here when everything else was peaking. 497, 510, a little bit down. And we're right. I mean, you're talking 2.4% change in these prices. My prediction would be, if I'm looking at this, just based on what we're seeing now, based on the fact there's not a lot else to build in Oviedo and City of Orlando, supply is trending in the right direction. Interest rates are trending in the right direction. And I think we're going to really start to see things move positively. So I wanted to just make sure that we have the ability to understand how we're going to be able to reflect on this. Now, it's Friday. If you're listening to this and you got this far, I appreciate it. Thank you so much. I'm going to try and keep bringing valuable things that you can learn to kind of really sink in, talking points. But it's Friday. We've got a running joke. I don't know why our office is so quiet on Friday. So if you're part of our office, get in here. I know you're probably showing houses. That's good. Come back to the office. Because our ability to not check out for the weekend and to plan for the weekend is dramatic. Now, here's what I'll challenge you. Go take a peek at your goals for this year. We're only a month out from when you set them, month and a half out. Probably are not on track unless you cheated at the beginning and had a bunch of stuff rolling into January and you're telling yourself you're on track. The stuff you've created this year is probably not yet on track, but the Super Bowl is coming. Like, our spring market is picking up to be a stellar spring market. We're feeling it. We're seeing it. The lead flow is already happening. The saturation time of a call that comes in to when they actually want to buy is improving. And I believe that is because people have waited out the interest rate part of the market long enough. And at some point, if you got to move or you want to move or you need to move, you move. And rates are moving into a direction where people are saying, everyone is saying, we're not going to get a lot more relief here. This is probably where they're going to stay, right? We've got a buyer, we were quoting yesterday in the upper fives, 5.8, 5, something like that. Most of them are primed right at 6. And so if you know that is not a variable that's going to change, and you know that buyers are ultimately going to be jumping back in, there's an opportunity right now, and we've got to be speaking to that, because I don't see, when we reflect back on, share this 10, on the build up, the bottoming out, I don't see this period where we go back to here, you know. And one of the reasons, when you understand nationally what's going on, affordability is a challenge. Got it. Is the house the issue? Would it shock you to know, and this was not my information, I'm just repeating it. Would it shock you to know that 40% of the single family homes in the United States are owned outright? No mortgage. Shocked me. Like, that can't be right. I talked to, I was having a conversation with a financial, like a wealth planner, and he said that can't be right. That's right. And so, knowing that, what do you expect? Are we going into this period of utter downfall, or do we need to be speaking into like the opportunistic mindset of most of our buyers? That is like, if you're going to buy, like, don't wait until everyone else is buying. Buy now. If you're going to be there less than 3 years, maybe you don't buy. I don't expect we're not going to have a run like before. But if you know where you want to be and you're going to be there for a long period of time, make the commitment. Let's get serious. Let's make a purchase before the market goes on this run. Last thing I'm going to leave you with, and I think this is something we've got to just understand in regards to market as a whole, is when we look at available inventory. So just inventory in a particular community or in a particular metro. The challenge is that is based on speed of sales in the market. Like, so if one home sells per month in that neighborhood and you have 12 homes available, you have 12 months of inventory, right? That's how that would be calculated. The challenge is, when you look at that more in a macro sense, how many of those buyers are going to make a purchase, or sellers are going to make a purchase when they buy? So I think we've got when we look at the statistics around inventory and speed of markets, it can shift fast, because when new buyers jump into that neighborhood and scoop up 6 of them, we now got 6 new buyers who are going out and have to buy something. Right. So I think our market, the pent up tension in our market is underreported. Right. And that just makes sense philosophically. Over long haul, maybe it's not. But in the short term, there are a lot more buyers in our market that have to sell before they buy. Okay. So that's where I think builders have the hardest time, because they're trying to predict, well, how many of those want to get in something new? How much more new inventory do we need? Do we have capacity for? That's a challenge. I get that. So I appreciate you guys being a part of this. Thank you for listening. Have a great weekend.